Since the beginning of 2023, Johnson & Johnson's stock price has fallen approximately 13% since the beginning of the year, bringing it what appears to be in fair value based on a PE ratio of 15 and an earnings yield of 6.57. The company now offers a dividend yield approaching 3% at 2.91% after yesterday's close. So has Johnson & Johnson now become a buy, a sell, or a hold? Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, also known as Mr. Valuation to many of you. And, valuation is always so near and dear to my heart. And Johnson & Johnson is one of, two AAA rated companies. And it's one that actually it's a very large position in our portfolio. And I do want to talk about that a little bit. The question is, it's recently fallen, as I indicated in the intro here. Has the stock now become a buy, sell, or hold? So what we're going to do is we're going to run Johnson & Johnson by the numbers through the Fast Graphs Fundamentals Analyzer software tool, but we're also going to talk about some other research reports and try to cover some of the things that are concerning people. And then we're, going to conclude this by saying, would Johnson & Johnson be a good buy, sell, or hold? And so let's go ahead and get into the video and get into the Fast Graphs. The first thing I want to do is I want you to note the consistency of Johnson & Johnson's earnings growth. Other than, coming out of COVID here, we had a little bit of a blip. That was really the only blemish going back to 2003. I also want you to notice that the orange line is a PE ratio of 15. Okay, and that's an earnings yield of 6.67. And right now, Johnson & Johnson, as of yesterday's close, was trading at a PE ratio of 15.23, a blended PE, I might add, which, brought it right at fair value, giving it an earnings yield of 6.57, which is close to the minimum threshold of 6.67 that I like. So it's, theoretically in value. Now, the question is that a good time to be buying a stock like Johnson & Johnson, AAA rated, only has 24% debt, or, would you look for a better entry point? And the question is, do you take the chance of waiting for a better entry point? Or is this going to be as low as it's going to be? Because as you see, since going all the way back here, since 2013, Johnson & Johnson, only during COVID, during this period of time, did it actually get to a PE ratio below 15. The only other time it got to a PE ratio in this roughly 20-year holding period below 15 was coming out of the recession of 2008 and 9, which, as you can see here with the gray shaded area, was one of the longest recessions we've had in history, going all the way back to the Great Depression of, the 30s, of 1930. Now, the bottom line is, I also want you to note that Johnson & Johnson went through that Great Recession fundamentally very strong. Their earnings actually grew at double-digit rates. Now, coming out of the recession, it did slow down for a couple of years, but also that was a function of being big. But also notice that the dividend on Johnson & Johnson increased all those years. But we have a relatively large position in Johnson & Johnson, and we purchased it initially on April 12th. And this is as close as I can get because I'm only showing weekly closing stock prices here. So, at April 10th, the stock was trading at $51.41. It is now trading at a price of $155.56. So even after correcting down here, by 13% this year, we still are averaging double-digit returns, owning an extremely high-quality company with really modest debt levels. Now, there are some risks in Johnson & Johnson, and I'll be covering them as I go through here, but let's first take a look at the numbers. Now, I do want you to note that, from my point of view, this is a 7% grower. That's going back historically. And I'm going to take the price off the graph here so it doesn't confuse you. I'm focusing on this orange line. I'm also going to take the normal PE off. So operating earnings have grown by 7%. Okay, if I drop this down to 10 years, that number drops to 6%, so a little bit of a slowdown. If I drop it to the last 7 years, which includes some forecasting data, we're down to 5%. If I look at forecasting calculators, there are 2019 and 18 analysts forecasting 3.8%, about 3.61 for this year, 3.65 for next year, and 4%. The longer-term growth rate, which would be 5 years or longer, is estimated to be 4.58%. Now I can go to external links here and I can go into Yahoo estimates because I'm trying to think my way through the process here with you. If I go through long-term estimates, the analysts reporting to Yahoo say 3.94. So what we've got is a relatively consistent, around somewhere between, let's say, 3.5% and maybe 5% estimated long-term earnings growth. And we've got earnings growth of about 3.8%. So the point I'm trying to get at is this company, which now has a market cap of $401 billion, is, getting rather large, and it's getting harder and harder for this company to grow. All right, so the growth rate is slowing down. But let's examine the price action because of the quality of this company. If we look at the price action, you can see that J&J was trading at very high PE ratios in the mid-20s, going back into 24, even got as high, as 21 times earnings. And if we look at this from a standpoint of valuation, 15 would be our ideal PE. This was a 25 PE on January 3rd, 2003. I can go all the way out here, to, let me get January. Oh, this is close enough. February 2nd of 2012. And I made less than 4% a year on my money. Now, the reason for that's a positive rate of return, but that barely is, more than the dividend. That's because you were overpaying for Johnson & Johnson in the first place. Like, I showed you earlier, I started purchasing this stock around April 11th, and as close as I can get here, I'm having trouble here because I'm looking at a long time frame, but I ended up making double-digit rates of return by buying the stock when it was undervalued. And that's the real key. Forget about the specific dates. There was a time I actually kept accumulating Johnson & Johnson over the next 2 or 3 years for new clients or clients that were switching from growth to income and so on, because I was getting good dividend yield and I was able to buy this AAA rated company, very attractive valuation. Now, the normal PE ratio, which is the average PE ratio of the market applied, trimmed average, I might add, has been a little higher, been about 16.77. I call that a quality premium. It was not very unusual for the market to put a premium above the 15 PE. In fact, you can see you only get a chance to buy Johnson & Johnson at a 15 PE ratio occasionally. You had this extended negativity coming out of the 08-09 huge recession. Otherwise, you just had periods where it got close, and stayed there for a fleeting moment and then went back into higher PEs up into 17, 18, et cetera. And again, if I change time frames, these numbers change a little bit because we're dealing with different growth rates and different price action. But this is an analytical tool. As I view this and analyze it, I can see that this is a 17 PE ratio, and that, runs right through the stock price. And I can see there are times when it's a little higher than that, times when it's a little lower than that. But it gives me a good indication that the market does put a modest premium on this stock generally, something around 16 to 18 times earnings. And the 15 PE ratio is a fair value ratio, but the stock only touches that, every so often. It's not a good time, as it's doing right now. So you could make the argument, is this a good time to buy Johnson & Johnson? Well, I would say if you're looking for quality and something around a 3% dividend yield, I would say Johnson & Johnson would probably be an attractive buy now. I've now moved it onto my income list of stocks that I would buy for income. As long as it stays at this 15 PE ratio-ish or lower, I would add it for those accounts that could use a 3% yield where that would meet their goals and objectives and have a nice quality holding with some modest capital appreciation. But now looking at that, going forward on that, I want to be clear, at a 15 PE, if Johnson & Johnson were to earn, what the analysts are expecting, you'd be looking at making about 6% a year. If you use the normal multiple, which is closer, now the last 5 years, it's been 17.7. I could even, use the drop down here and find out, but you can see a 17 multiple is, pretty normal. So I'll take the lower one here and just do 17. So at a 17-ish multiple, you could maybe then get double-digit rates of return. But now what you're expecting there, what you're assuming there, is that Johnson & Johnson trades back up to the blue line here, okay, not the orange line. But the point is, it's got a positive growth rate. It can make 6, 7, 8%, maybe 10% a year if you bought it today. depending on best case, worst case, mid case scenarios. It's a very solid holding. It's AAA rated, and it looks very attractive. Now let's evaluate dividend safety a little bit. Let's look at operating cash flow. Now, when I'm doing operating cash flow, I actually, believe it or not, like to take price off the graph, because I'm not really trying to value the stock necessarily by operating cash flow as much as I'm trying to say, do I have plenty of cash flow to cover the dividend? And this is not cash on hand. This is just generating cash flow year by year. And my answer is yes. I'm getting, last year I got almost $8 in cash flow for a $4.45 dividend. This year I'm expected to get $11.50 in cash flow to cover approximately a 4.74 estimated dividend. So I've got plenty of cash flow. And then free cash flow, is the acid test, what's left over after running the business. I also got very good free cash flow coverage. Okay. Now I can look at other metrics, and I always do this. I go through every metric I can. I look at EBITDA, and what I do with EBITDA, now I do like to value a stock based on EBITDA, meaning that I like to see how the market has valued it as a multiple of EBITDA. And the normal multiple on J&J has been about 12.19. It's currently 12.77. So again, it's in fair value range based on EBITDA. If it's overvalued, it's just a smidgen. Okay. It's not like, oh, this is dangerously overvalued, which is what I really worry about as a value investor. It's within range. And keep in mind, a lot of this information is based on estimate data, which will probably be wrong. Now, having said that, if we look at the analyst scorecard of Johnson & Johnson, on the 1 year forward estimate, the numbers have been pretty good. On the 2 year forward, with a bigger margin of safety, it's been almost perfect. And that's looking at it from an EBITDA point of view. If I go to adjusted operating earnings, it has a really excellent record. And the company just did beat on earnings, but I might also add they came in a little short on sales revenue, but their sales revenue targets have generally been very good, but it wasn't greater than the 10% margin. I might point that out. So all in all, Johnson & Johnson has been a very consistent, very reliable stock. It's trading at a premium to its normal price to sales of about 3.91, but that's a number. Okay, I want to make sure that those of you who are subscribers are using this tool correctly. I'm analyzing that number. 3.91 was a pretty good number back here coming into the recession. Just before the recession, that got around 3. It got down to a 2 or 3 times sales and stayed there for many, many years. And then it traded around that 3.91. This is just a reference line. Okay, 3.91 times sales. Now, for the last 5 years, it's consistently traded above that, and it's currently trading at about 4.3 times sales, but it has been trading at 5 times sales. I'm using the dynamic nature of this tool to analyze this stock and analyze what I'm looking at. All right, so as I've run Johnson & Johnson through all these metrics here, everything from earnings, cash flows, and sales, I feel very, very good. Now, you can also look at GAAP earnings with the Fast Graph tool, and this is, including some non-recurring, non-cash charges, write-offs, and depreciations, and so on, to just give you an idea of how the company is functioning. The operating earnings and the cash flows give you more of a look at how the business is actually performing on a straight operating basis, if you will. Okay, and that's how you use that differently. But now let's go ahead and step into the financials for a minute. And the one thing I want to look at, and I want to talk a little bit about some of the risks. Okay, so we can go with Fast Graphs, we can go right into the financial statement and go into the balance sheet. And I want to point out the company ended last year with about $23 billion in cash. That was down from $31 billion the first year, which was up from $25 billion in 2020. The point is the company has an enormous amount of cash. Now, if I use my external links on Johnson & Johnson and go into some other websites here, I happen to subscribe to Morningstar, so I can click on this and go into Morningstar. And then I can read some information. Now, Johnson & Johnson does face some litigation on talcum. There's somewhere between 38,000 and 40,000 cases that are still pending. But those expensive, Johnson & Johnson has a reserve of close to $6 billion with an additional $2 billion as likely to sufficiently cover the talcum powder legal costs. And there's also some opioid costs, which they've also limited those. Now, the federal bankruptcy court did deny Johnson & Johnson a tactic where they were trying to make sure all this litigation went into bankruptcy proceedings, but they failed on that. But the company still has a formidable amount of cash and ability. So, as Morningstar said, it did not impact their outlook for the company. Now, they give it a fair value of 164. It closed at 155, and they give it a 5-star price of 131. Now, let's talk about that. If I go back to my fast graphs here, a 5-star price, okay, I'm going to use operating earnings. A 5-star price would be, something below 15 times earnings with Johnson & Johnson. Our fair value would be 155 on fast graphs. So if I went into the forecasting calculators and they're looking at, a 5-star price of 131, okay, to find that, I would use these different PE ratios here. And I'm just trying to get close here. There's 138, there's 122. So it's somewhere between these two orange lines would be a 5-star price, which would indicate when Johnson & Johnson was trading below its intrinsic value. In other words, that's what was happening here, and even what happened very, very slightly during COVID. So those are the best times to buy this. Very high quality, very consistent, great dividend record. The company has grown their dividend, as you can see. Forget about, valuation for a moment. It's grown their dividend at around 9% a year, but that rate has slowed down a little bit. It's still averaging around 6% growth in recent years. Now, the performance, historically, Johnson & Johnson has performed, pretty consistently with the market, but it underperformed it on capital appreciation, but I meant to say consistently produced more dividend income than market. But I also want you to always be clear when you're looking at performance, measuring performance without simultaneously measuring valuation is a job half done. I've said that for years. And what you're looking at is a time here when Johnson & Johnson was very, very expensive. If I shorten this time frame, okay, and what I'm trying to do is calibrate a time when Johnson & Johnson is more reasonably valued. And now when I look at performance, Johnson & Johnson has still slightly underperformed the market, but it's performed better, but it's still outperformed it on dividend income, $6,500 on a $10,000 investment versus only $4,000 in the SPY. So valuation matters, and it matters a lot. And keep in mind, the market is an average of all companies. This is a significantly above average company. We're talking about Johnson & Johnson here, which once again is why the market likes to put a premium valuation on the company. Okay, but Johnson & Johnson has an enormous amount of cash. Now, they are doing some things. Another external link we can go into here is Seeking Alpha. There was an interesting article that I read where they talked about the Kenvue, which is the IPO, where they're separating their consumer products business out, and that'll be happening sometime later this year. They point out that this still leaves Johnson & Johnson with most of the talcum liabilities. That's true, but they have the reserves to cover that. So I don't think the litigation is going to really change the viewpoint, as Morningstar said, on Johnson & Johnson going forward. Now, companies like Zacks Investment Research, pointed out that there are good reasons to buy Johnson & Johnson. They had above market performance of their pharmacy unit. It is extremely well diversified. J&J continues to expect its pharmaceutical business to deliver market-leading adjusted operational sales growth in 2023, despite the Stelara loss of exclusivity in the second half. Okay, they have a long-term goal of growing the pharmaceutical unit into a $60 billion segment by 2025. They've also made several deals recently, as according to Zacks now, to boost their revenues. They acquired Swiss biotech Actelion, I think is how you pronounce it, Actelion, for $30 billion. They acquired Momenta Pharmaceuticals, which added a product called Nipocalimab to its pipeline. It's a mid and late stage development for rare diseases that has the potential to create a pipeline in a product. They also have sufficient funds to pursue additional bolt-on, acquisitions. I showed you they have over $23 billion in cash. The company's key area of focus are immunology, infectious disease, vaccines, neuroscience, cardiovascular, metabolism, oncology, and others. So, the company has a very, very strong pipeline. They have expanding labels of marketed products, which is part of boosting their pipeline. Now, talking about some of the risks a little bit, which I think is only fair to do. The shares have been underperforming industry recently, but that's based on price decline. Okay, the generics have begun to hit their sales as they've lost some patent on some stuff. They're also, like most companies, facing macroeconomic, headwinds, including inflation and higher input costs. That's happening across the board. They also expect, J&J that is, expects supply constraints and inflationary pressure to continue to hurt margins in 2023. Now, the numerous litigations, what everyone's going to talk about, as I mentioned, they already got reserves on that, and they've got the cash to handle that. But they do face, as I said, somewhere between 38 and 40,000 lawsuits for the talcum-based products alone. And, they allege that their products contain asbestos. And J&J still, vehemently contends that their talcum powder has always been safe. There was obviously uncertainty surrounding the pandemic. It has hurt demand trends of physician-administered drugs, according to Zacks. And then there was also some pipeline setbacks. All right, so, Johnson & Johnson, like all companies, does have some risks. But it appears to me, at least, that those risks are very well contained. And I think that's one reason why you're looking at a AAA rating on this company. So, coming into conclusion here, I would say this is a good time to take an investment in Johnson & Johnson if you're looking for a 3% or approaching a 3% yield that has the potential to grow, at say 5 to 9% a year over the next several years. I think that's still in the pipeline. Now, it's not going to be real fast growth, somewhere around 4 or 5%, but you're dealing with a very extremely high quality company with a lot of resources, a very strong balance sheet, low debt, AAA rating, and you're now able to buy it at what is historically, looking at, the 20-year decade, this is historically an attractive valuation. It's not major attractive like it was here. Now, when I bought Johnson & Johnson, I want to be clear about something because I don't want to give the wrong impression. I bought it on April 12th. Okay, that's as close as I can get to that. And, around $50 a share when I first bought it. That was almost a perfect bottom. Okay. And as I said, that led to, even after this 13% correction, that's led to me earning double-digit rates of return. I've tripled my money on the stock on the initial purchase, and I've also received another, 85% of dividends. So I've almost quadrupled my money over this period of time, owning one of the highest quality companies in the world. But part of the reason for that happening was because the valuation was so attractive. I wasn't smart enough to pick the bottom here. I was just smart enough to understand that this was an extremely low valuation at Johnson & Johnson, and I had been waiting for years to acquire it. So I, stepped up and bought as much of it as I could during that time. And I continued to purchase it for several years after that. And then I start backing off coming into 2014. My prognosis today is I have Johnson & Johnson as a strong hold. I'll continue to hold it. I could possibly add it sparingly to some new accounts that are opening up that are looking for safety, as well as, a dividend. As long as I can get close to a 3% yield, I'm pretty comfortable with it growing. But I am not backing up the truck here. I don't consider it a screaming buy. I just consider it good value in a very high quality investment with a decent dividend yield that you can buy relatively safely today for the long run. But it does not have the margin of safety it had coming out of the 2008, 2009 recession years, or even the smaller margin of safety that we saw with COVID. But it's at good value, considering that the market, historically puts a premium valuation on the stock. So anyway, ladies and gentlemen, this is Chuck Carnevale, co-founder of Fast Graphs. I hope you enjoyed this video, taking a look at Johnson & Johnson. I do consider it buyable today. I don't consider it a screaming buy. I consider it fairly valued, if not just a tad bit fully valued. But, if safety is what you're looking for, it certainly makes sense to buy it. Now, I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel, of course, and also take a look at subscribing to Fast Graphs. You can see just by going through some of the machinations I did here with, covering Johnson & Johnson, how effective it can be at helping you make more prudent, long-term, solid investment decisions based on good valuation, based on fundamentals. Thanks for watching. Talk to you again real soon.